Everything mentioned in this video should be considered opinion only and not personalized investment advice.
This is a special 4-part video series of the 4 horsemen of the economic apocalypse that we're all about to face. And what does this all lead to? Well, I'll say for now it leads to deja vu, but I'll let you guys decide what it leads to once you watch all the details I'm about to give you. Click on that alert bell so that you get all these new videos right when they come out, because it's a 4-part video series. You're going to want to watch all 4 parts and then see what they all combine to lead towards. I'm going to start off with the one that you know probably all too well, and that's debts. And I'm going to read you a quote from an article. Biden's plans to raise taxes on corporations and the wealthy are losing momentum. You see, that's what they do. They'll say that they're going to raise taxes on the wealthy to pay for everything that they promise, and then when it comes down to it, then they back off of that, and then people have voted already, and then it's too late, and they just move on. But let's get into the meat of this that you guys need to know. Total consumer debts hit a record $14.6 trillion. Debts held by the public are approximately 77%, 78% of GDP. When compared to 207 countries, the United States ranks 43rd. But don't just worry about consumer debt. There's other debts that are going to be problematic. For example, corporate debt. You know, I tell you guys always about municipal debts, federal debts. Corporations have a ton of debt, and that's a problem. There's a debt bubble there. And we're going to get into this all as we go. All debts from corporations total about $10.6 trillion, which is 50% of the nation's entire GDP, which is, again, the highest in history. Do you guys notice that all the time I'm talking about stats and it's always the highest or a record or never before seen numbers? That's what we're talking about. Things have just gotten way too extreme. They're being stretched to the limit. A big part of that is the incredibly low interest rates, which allows for taking on more debt and making it easier to pay those debts, which you could probably understand that if interest rates do increase, which is what's going to have to happen if they're going to fight inflation, then that means that there's all of a sudden this extra weight on consumers, corporations, municipalities, and the federal government. If interest rates go up a fraction of a percent, all of a sudden the government has so much more money it has to bring out or bring to bear to pay the carrying costs on the national debt. And that applies to you on a credit card, it applies to a municipality, all of that. It's gotten way too extreme, and it's an untenable situation. It's gotten to the point of a corporate bond bubble for all corporations, but even companies like Heinz, Ford are issuing junk bonds now. And they're just being gobbled up. They're being bought up so aggressively. But let's look at the debt to GDP ratio. That's a metric which compares a company's public debts to its gross domestic product, or the weight of all the production of the entire nation. When you compare what a company or a country owes or a person owes to what it produces, so for example, how much do you owe, how much do you make per year as salary, that's what you produce, so to speak. That's one way to look at it on a personal level. But when you compare what a country owes to what it produces, the debt to GDP ratio indicates a nation's ability to pay down its debts. And as a nation, the United States, our debt to GDP ratio is 108%. Is that really high? Yeah, it's one of the highest, but there's a lot of other countries that have even higher debt to GDP ratios. And we'll get into that just ahead in this video. So when you add consumer debts to corporations' debts, the country's debts, put all together, how much debt does the country have overall? Last year, it was $26.5 trillion. It's a big number. So is that too much? It depends. One way to look at it is the carrying costs. To have that debt level, you don't have to, just like a credit card, you pay down the interest payments, you don't necessarily have to pay down the principal amount that you owe. You could owe $10,000 and you got to pay $500 interest. How much is that carrying cost? $500. For the country, the carrying costs right now are $404 billion. $404 billion, which produces nothing. It does nothing except allow us to have the debt level or the debt load that we currently have. At current really ultra low interest rates, we're barely able to manage this level. But if interest rates even tick up 0.25%, that's massive amounts of money. Billions of dollars which suddenly we have to come up with, which we give to service the debts, which gives us no kind of advantage whatsoever. When interest rates go up, the stock market and the economy and the corporate bond bubble, all of that is coming down.
And I'm wrong plenty of the time, and it's opinion, and it's not meant to be personalized trading advice, but I do expect that we are going to see exactly what we saw before happen again, because things are setting up in such a similar way. Who knows when it's going to begin? If it has already begun, we might not even know it. Who knows when it's going to begin? Who knows how bad it's going to be?